And this is going to accelerate. And not only is it going to accelerate among central banks, but institutional investors and retail investors are going to finally start to participate. So, a $10,000 gold price is not that far off. It's only about a triple from here. But, I think it could easily be done over the next, maybe 3 to 5 years. But silver is very cheap. And so I've been a real promoter recently, last, 6 months in particular, even before when it was 100 to 1, when you could get 100 ounces of silver for 1 ounce of gold. And, it's not quite that cheap anymore, but it's still historically cheap. So I really like silver.
PeterSchiff has long argued that gold's role as the ultimate store of value is becoming increasingly vital as confidence in fiat currencies weakens. Central banks around the world have been steadily increasing their gold reserves in recent years, and the trend shows little sign of slowing down. The shift is largely a response to rising geopolitical tensions, the weaponization of currencies through sanctions, and the perception that reliance on the US dollar exposes nations to unnecessary risks. By diversifying away from dollar-denominated assets and allocating more toward gold, central banks aim to protect their financial systems from external pressure and currency instability. This movement has become one of the most powerful forces behind the sustained strength of gold prices. Schiff often points out that beyond central banks, the broader investment landscape also supports the case for continued gold demand. Equity markets in the US remain historically expensive, while many international markets offer relatively better valuations. For global investors seeking balance, the appeal of gold lies in its long history as a hedge during times of economic imbalance, currency weakness, or financial volatility. The fact that gold has outperformed major equity indices over multi-decade periods underscores its strength as a store of value, even in the face of powerful bull markets in stocks. As liquidity flows increasingly diversify away from U.S. assets, both institutional and retail investors are likely to follow the example of central banks and expand their allocations to gold. Perhaps the most striking observation Schiff makes is how underrepresented gold remains in American households. Less than a small fraction of the population has direct exposure, even though risks in the global system continue to grow. Many U.S. investors have instead poured into speculative alternatives such as cryptocurrencies, often mistaking them for a replacement to physical assets like gold. The reality, Schiff argues, is that when speculative bubbles deflate, the absence of a true hedge becomes painfully clear. As awareness spreads and volatility in digital assets continues, more individuals may come to recognize the role gold plays in preserving wealth through crises. This shift, combined with central bank demand and institutional adoption, could lay the foundation for a powerful long-term revaluation of gold in the years ahead. Before we dive into Peter's sharp insights from her latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Well, first of all, if countries stop buying oil from Russia, it's just going to make oil more expensive because if they have to buy it someplace else, you're just going to shift the demand and we're going to end up paying higher prices. Ultimately, Russia is going to sell the oil anyway. It's going to get it out of the country. So it doesn't make any sense to put those sanctions on. And all it does is piss off people. Like it gives people another reason to get out of the dollar and get out of U.S. treasuries. I mean, countries don't like being sanctioned. They don't like being pushed around. I mean, we wouldn't like it either if some other country was doing it to us. So America benefited from other countries using our currency. We got the seigniorage gain. We got artificially low interest rates too, and we got lower consumer prices. But we're pushing all that away. We're, biting the hands that have been feeding us. So it's generally not a good idea to do that. I mean, just like I said, you're seeing a movement of investor money being reallocated, right, out of the U.S. abroad, not only to, get away from a weak dollar or capture the appreciation of rising foreign currencies, but U.S. market is expensive. Our stocks are because of this huge, massive bull market we've had, which is really a bubble. Stocks are very expensive in America. They're not expensive in a lot of other markets. In fact, in some markets, they're cheap. So that's a big deal. But the other big rotation is the one that central banks are making out of U.S. dollars and out of U.S. treasuries into gold. And that has been the primary driver of the gold bull market. And gold has outperformed the S&P so far in the 21st century. 25 years, you're better off January 1st, 2021, if you just bought some gold coins from Schiff Gold and put them in your sock drawer and just left them there for 25 years, you've beaten the S&P 500, even with the dividends on the S&P 500. So that shows you what's really going on. And this is going to accelerate. And not only is it going to accelerate among central banks, but institutional investors and retail investors are going to finally start to participate. So, a $10,000 gold price is not that far off. It's only about a triple from here. But, I think it could easily be done over the next, maybe 3 to 5 years. I think the S&P is maybe up around 10% this year, which is about how much the dollar is down. So if you're an international investor, you're looking at no return on U.S. stocks. Meanwhile, I look at my mutual funds. I have 5 mutual funds. One of my mutual funds is called the Euro-Pacific International Dividend Payers Fund. And we buy dividend-paying stocks outside the United States. So, higher dividend-paying stocks. So typically, these are more conservative type stocks. So they're not growth oriented. We're buying them because they pay good dividends. Well, that fund year to date is almost up 40% now. Now, yeah, about 10% of that is foreign exchange related, but still that is, a huge performance gap. I mean, basically we're making 4 times the money investing in foreign stocks as we would be investing in the S&P. And that is a big signal to capital allocators around the world to jump on board this train. And so I think you're going to see a lot of money leaving the U.S. markets. Money that has been sucked into the U.S. markets for the past 10, 12 years is now going to get sucked out. And that means foreigners who have U.S. investments are going to sell their U.S. investments and bring their money home. But then Americans are going to sell their U.S. investments and send their money abroad. And so that's what's really going to be helping. I mean, my asset management company, Euro Pacific Asset Management, because that's what we specialize in. And again, gold stocks are up now close to 80% on the year, 77% for the GDXJ. This is the best year on pace that I can remember. I mean, there may have been a better year in the early 1970s, mid 1970s, but this I think is the biggest year, single calendar year that I can remember on pace, because I think we could finish the year where the GDX and GDXJ, these are indexes, double in value, 100% gain in a single year. And gold stocks year to date are the best performing sector, gold and silver mining stocks in the U.S. stock market. They're beating tech, right? They're beating crypto. They're beating whatever. Like whatever you think is the best, it's not. It's gold and silver mining stocks. And they're getting no coverage. If you watch the mainstream financial media, you'd have no clue that these stocks were doing so well.
PeterSchiff warned that the renewed push for tariffs as a solution to America's trade problems could backfire in ways policymakers are not fully acknowledging. Supporters of tariffs argue they will bring back jobs and protect domestic industries from unfair foreign competition. However, Schiff pointed out that this approach overlooks the long-term consequences of higher import costs filtering through the economy. Industries that rely heavily on foreign materials or components would see their expenses rise, forcing them to either absorb losses or pass the costs on to consumers. This ultimately translates into more expensive goods on store shelves, weakening household purchasing power at a time when inflationary pressures are already a concern. Schiff emphasized that tariffs tend to create distortions rather than solutions. While they may provide temporary relief to targeted sectors such as steel or aluminum, the broader effect is often negative. Companies dependent on affordable imports struggle to stay competitive, both in the domestic market and overseas. Over time, this can lead to reduced output, job losses, and even closures in industries unrelated to those receiving tariff protection. As Schiff explained, shielding certain producers with trade barriers does little good if downstream businesses and consumers are forced to shoulder the economic fallout.
Trump is correct to point out that we're not producing enough, we're not manufacturing enough, and we have these big trade deficits, right? But these are consequences of problems that need to be fixed. You can't deal with the problem by dealing with the symptom. It'd be like if I had skin cancer and so I just put a Band-Aid on the cancer so I couldn't see it. That doesn't solve my problem, right? I got to get to the underlying cause that's resulting in that visible, a blemish or whatever. And so the trade deficits and the outsourcing of our jobs are symptomatic of an underlying problem that Trump is leaving unaddressed. And the problems that we have are homegrown, right? We don't have trade deficits because foreigners are cheating. we have trade deficits because of our own economic, regulatory, and fiscal policies that have undermined our competitiveness. And also, we do have an overvalued dollar that's problematic in a way too. But it mostly has to do with taxation and regulation, including, the labor laws and all that. And so what Trump is doing is saying, well, let's just make it a lot more expensive to import, and that's going to fix the problem. It's not, because a lot of U.S. companies that still do manufacture, they've outsourced a lot of the components, and they import those components. And now those components that U.S. companies rely on are going to get a lot more expensive. And that's going to diminish their sales here at home, but also make their exports less competitive because they're now competing with companies that don't have to pay those tariffs. So all of this ultimately is going to make America less competitive, and we're actually going to lose manufacturing and lose manufacturing-related jobs as a result of the tariffs. And, and even the industries that are initially helped by the tariffs will be hurt. Like, let's say with steel and aluminum, we have a 50% tariff on imported steel now. So yes, obviously, the steel companies are going to hire more people because now they have to produce more steel because, they're cheaper now because of a 50% tariff. But because steel is a lot more expensive, the companies that use steel won't be buying as much. Some of them will be shutting down operations. Some of them will be going out of business entirely. And so at the end of the day, the steel companies are going to end up losing business because the steel tariffs put their customers out of business. So none of this is smart economic policy. So Trump, inherited a bad economy from Biden. It's BS to say that we had a good economy. We had a bad economy. That's why Trump got elected. But the bad economy that Trump inherited is getting worse. In fact, it's already worse. I mean, even Powell acknowledged that today without specifically calling out Trump. But he mentioned that in July 2025, relative to July 2024, we have a much weaker economy and much stronger inflation. And the budget deficit in July was 20% greater than it was a year ago, July. So with Trump, we have bigger deficits, higher inflation, and a weaker economy. That's the fact. Meanwhile, Trump is out there talking about how we got the greatest economy in the history of the world. We've got the hottest economy ever. All those, it's all BS. None of it's true. Well, I think it's very damaging. I mean, I think the fiscal policy is horrible. The big, beautiful bill exacerbated an already large deficit problem. They took all the Biden spending that they campaigned against, the Republicans, and they kept it all, and then they added to it. So we've got bigger deficits. The tariffs are a net negative. Yes, the government needs revenue, but raising them this way is going to help make American businesses less competitive than they are now. And of course, it's going to increase the burden on the poor and the middle class who are already struggling as inflation erodes away the value of their wages and whatever they saved. And I think a lot of other things that Trump is doing, that he's misdirecting resources towards crypto and those type of businesses to the expense of other businesses that we actually need more than this crypto nonsense. He's taking a heavy-handed approach to trying to micromanage companies, getting the government to make deals with private companies or, have taxes on their exports, which is, totally unconstitutional. But there's a lot of stuff that's being done that is undermining capitalism. It's copper, nickel, also as how they play into the electric, stuff, electric cars and all that, and the data centers that are being built. I mean, there's going to be a lot of demand for the raw materials. I think energy is cheap. Natural gas, oil is cheap. Agricultural commodities. I'm bullish pretty much on the whole complex of commodities. They're all going to be bid higher with all this inflation. And especially, as the dollar really tanks, if emerging markets are a main beneficiary of a weaker dollar, then they're going to consume a lot more commodities because, they're going to start consuming more of their own production. Instead of exporting stuff to America, they're going to build stuff and keep it. But I think there's going to be a lot more energy because they're going to produce a lot of things that are more energy and resource intensive when they're no longer just exporting trinkets to America. They're producing goods for their own consumers. So, we could see a real boom in commodities. And of course, this means that commodities are going to be a lot more expensive for Americans too. Just a lot of Americans won't be able to afford to buy them. They'll be priced out of the market by the weak dollar.
Looking ahead, the trajectory of gold and silver prices appear set for a significant revaluation as global financial tensions deepen, with mounting debt levels, persistent inflation, and weakening confidence in major currencies, investors are increasingly gravitating toward assets that offer real and lasting value. Gold, long regarded as a store of wealth, could see a surge as central banks quietly expand their reserves, signaling a move away from reliance on paper promises. Silver, often slower to react, may ultimately deliver sharper gains once momentum builds, driven not only by safe haven demand, but also by its critical role in technology and industry. If current economic pressures intensify, both metals stand poised to break through previous ceilings, reshaping how wealth is preserved in the years ahead. Let us know your thoughts in the comments below. And if you found this video insightful, don't forget to hit the like button, share it with others, and subscribe for more content like this. Your support means everything.